The History of Interest Rates Over 670 Years. By Tyler Durden. Monday, November 25, 2019, 23:25. Today, we live in a low interest rate environment, where the cost of borrowing for governments and institutions is lower than the historical average. It is easy to see that interest rates are at generational lows, but, as visual capitalist Nicholas L. Epan notes below, did you know that they are also at 670-year lows? This week's chart outlines the interest rates attached to loans dating back to the 1350s. Take a look at the diminishing history of the cost of debt. Money has never been cheaper for governments to borrow than it is today. The birth of an investing class. Markets have become over-emotional about rates, Voya CEO says. Trade brought many good ideas to Europe, while helping spur the Renaissance and the development of the money economy. Key European ports and trading nations, such as the Republic of Genoa or the Netherlands during the Renaissance period, help provide a good indication of the cost of borrowing in the early history of interest rates. The Republic of Genoa, 4 to 5 year lending rate. Genoa became a junior associate of the Spanish Empire, with Genovese bankers financing many of the Spanish crown's foreign endeavors. Genovese bankers provided the Spanish royal family with credit and regular income. The Spanish crown also converted unreliable shipments of New World silver into capital for further ventures through bankers in Genoa. Dutch perpetual bonds. A perpetual bond is a bond with no maturity date. Investors can treat this type of bond as an equity, not as debt. Issuers pay a coupon on perpetual bonds forever, and do not have to redeem the principal, much like the dividend from a blue-chip company. By 1640, there was so much confidence in Holland's public debt, that it made the refinancing of outstanding debt with a much lower interest rate of 5% possible. Dutch provincial and municipal borrowers issued 3 types of debt. Promissory notes, obligation short-term debt, in the form of bearer bonds, that was readily negotiable. Redeemable bonds, Losrenten paid an annual interest to the holder, whose name appeared in a public debt ledger until the loan was paid off. Life annuities, Liefrenten paid interest during the life of the buyer, where death cancels the principal. Unlike other countries where private bankers issued public debt, Holland dealt directly with prospective bondholders. They issued many bonds of small coupons that attracted small savers, like craftsmen, and often women. Rule Britannia, British consols. In 1752, the British government converted all its outstanding debt into one bond, the consolidated 3.5% annuities, in order to reduce the interest rate it paid. 5 years later, the annual interest rate on the stock dropped to 3%, adjusting the stock as consolidated 3% annuities. The coupon rate remained at 3% until 1888, when the finance minister converted the consolidated 3% annuities, along with reduced 3% annuities, 1,752, and new 3% annuities, 1,855, into a new bond at 2.75% consolidated stock. The interest rate was further reduced to 2.5% in 1903. Interest rates briefly went back up in 1927 when Winston Churchill issued a new government stock, the 4% consols, as a partial refinancing of WWI war bonds. American ascendancy, the U.S. Treasury notes. Never miss the news that matters most.
Come on.
Zero Hedge directly to your inbox. Receive a daily recap featuring a curated list of must-read stories.
Okay, get down
the
to the
United
other.
States Congress passed an act in 1870 authorizing 3 separate consol issues with redemption privileges after 10, 15,
Negative
and
interest
30
rates,
years.
like Japan.
This was the beginning
That's
of
how
what
low
became
they
known
can
as
go.
Treasury bills, the modern benchmark for interest rates. The Great Inflation of the 1970s. In the 1970s, the global stock market was a mess. Over an 18-month period, the market lost 40% of its value. For close to a decade, few people wanted to invest in public markets. Economic growth was weak, resulting in double-digit unemployment rates. The low interest policies of the Federal Reserve in the early 70s encouraged full employment, but also caused high inflation. Under new leadership, the central bank would later reverse its policies, raising interest
Paul
rates to
Volcker.
20% in an effort to reset capitalism and encourage investment. Looking forward, cheap money. Since then, interest rates set by government debt have been rapidly declining, while the global economy has rapidly expanded. Further, financial crises have driven interest rates to just above zero in order to spur spending and investment. It is clear that the arc of lending bends towards ever-decreasing interest rates, but how low can they go?
Just like Japan.
Business finance. 64. 71.